If you own a vacation home, you already know how rewarding it can be to have a getaway property. But along with the joys of owning a second home, there are also financial responsibilities. Mortgage payments, maintenance, and property taxes can all add up quickly. That's why many vacation homeowners explore refinancing options to reduce their costs, access equity, or make their finances more manageable. In today's video, we'll break down everything you need to know about refinancing a vacation home, the available options, and how to choose the best path for your financial situation. First, let's start with the basics. Refinancing simply means replacing your existing mortgage with a new one, usually with better terms. This could mean securing a lower interest rate, reducing your monthly payment, changing the loan type, or tapping into your home's equity through a cash-out refinance. The process for refinancing a vacation home is very similar to refinancing a primary residence, but lenders often treat second homes a little differently. Since a vacation property isn't your primary home, lenders may view it as a slightly riskier investment, and that can affect the rates and requirements. So why would someone refinance a vacation home? There are several reasons. The first and most common is to get a lower interest rate. If you purchased your vacation home when rates were higher, refinancing now might give you a chance to lock in a lower rate and save thousands of dollars over the life of the loan. The second reason is to reduce monthly payments. A lower rate or longer loan term can help free up cash each month, which could be used for travel, property improvements, or simply improving your overall financial flexibility. A third reason is to switch from an adjustable-rate mortgage to a fixed-rate mortgage, providing more stability and predictability in your payments. Finally, many owners refinance to access their equity. This is called a cash-out refinance, and it allows you to borrow against the increased value of your vacation home, using the funds for renovations, debt consolidation, or even purchasing another investment property. Now let's talk about the different refinancing options available for vacation homes. The first option is a rate and term refinance. This is the most straightforward type of refinancing. You replace your current loan with a new one that has different terms. For example, you might switch from a 30-year mortgage at 6% interest to a 30-year mortgage at 5% interest. Or you could choose to shorten your loan term from 30 years to 15 years to pay off your mortgage faster. A rate and term refinance doesn't involve taking cash out of your home's equity. It's simply about securing better terms. The second option is a cash-out refinance. In this scenario, you refinance your mortgage for more than you currently owe and take the difference in cash. For example, if your vacation home is worth $400,000 and you owe $250,000, you might refinance into a loan of $300,000, pay off your existing balance, and receive $50,000 in cash. This option is particularly attractive if your home has appreciated in value and you want to use the funds for improvements, paying down other debts, or funding another investment. However, keep in mind that cash-out refinances usually come with stricter requirements and may have higher interest rates than a simple rate and term refinance. The third option is refinancing into a different loan type. For example, if you currently have an adjustable-rate mortgage, also known as an ARM, you might refinance into a fixed-rate loan for more predictability. This can protect you from rising interest rates in the future. On the other hand, if you're planning to sell the property in a few years, refinancing into a new adjustable-rate mortgage might give you a lower introductory rate and help you save in the short term. Another option to consider is refinancing with a different lender altogether. Sometimes, shopping around and comparing offers can uncover better rates or terms than what your current lender is willing to offer. Some lenders specialize in second home mortgages and may be able to provide more favorable terms than general mortgage lenders. Now, before you jump into refinancing, it's important to understand the requirements. Lenders generally apply stricter standards to vacation homes compared to primary residences. They want to see strong credit, typically a score of 700 or higher. They also look for a solid debt-to-income ratio, often under 43%. And most lenders will require you to have at least 20% equity in the vacation home to qualify for refinancing. This means that if your property is worth $300,000, you should owe no more than $240,000. In addition to the stricter requirements, you should also be prepared for higher interest rates compared to refinancing a primary residence. Since vacation homes are considered a higher risk, lenders typically add a small rate premium. Even so, the savings from refinancing can still be significant, especially if you purchased the home when rates were much higher. Let's also talk about the costs of refinancing. Just like with your original mortgage, refinancing comes with closing costs, which usually range from 2% to 5% of the loan amount. For example, on a $250,000 loan, you might pay between $5,000 and $12,500 in fees. These costs cover things like the application fee, appraisal, credit check, title search, and lender fees. When considering refinancing, it's crucial to weigh these costs against the potential savings. A common rule of thumb is to make sure you'll break even on the refinancing costs within 3 to 5 years. So, how do you decide whether refinancing a vacation home is the right move? Start by running the numbers. Use an online refinance calculator to estimate your new payments and compare them to your current payments. Factor in the closing costs and how long you plan to keep the property. If you plan to keep the vacation home for many years, refinancing into a lower rate can be a smart financial move. But if you plan to sell the property soon, the costs might outweigh the benefits. You should also consider your long-term financial goals. Are you looking to free up monthly cash flow, pay off your loan faster, or access equity for other investments? Each refinancing option serves a different purpose, so choose the one that best aligns with your goals. Another key factor is the rental potential of your vacation home. Many owners rent out their properties when they're not using them. If your home generates rental income, refinancing to lower your payments can increase your profitability. However, keep in mind that lenders may ask whether your vacation home is also an investment property. If it's primarily used as a rental, it may be classified as an investment property, which comes with even stricter requirements than a second home. Finally, let's discuss timing. Mortgage rates fluctuate based on market conditions, so refinancing at the right time is critical. If rates are low, it might be an excellent opportunity to refinance. But if rates are high, it may be better to wait. Keep an eye on economic trends, and don't hesitate to shop around and get quotes from multiple lenders to ensure you're getting the best possible deal. To sum it up, refinancing a vacation home can be a smart financial strategy, but it requires careful consideration. You have several options, including rate and term refinancing, cash-out refinancing, and switching loan types. Each option has its pros and cons, and the best choice depends on your personal financial goals and situation. Remember to factor in lender requirements, closing costs, and the length of time you plan to keep the property. By doing your research and making informed decisions, you can lower your costs, improve your cash flow, or even unlock the value of your vacation property for other purposes. Owning a vacation home is a dream for many people, but managing the financial side of it requires planning and strategy. Refinancing is one of the best tools available to make your second home more affordable and more beneficial to your overall financial plan.